Now we're moving from paper 1 to paper 2 as we prepare for exam accounting paper 2 for grade 10, right? So this is the question that we'll be doing, which was the professional assessment accounting. It was the question November 2024. The total marks was 150 and the duration was 2 hours. So our focus in this question will be on question 2, which is the fixed assets, 32 marks, and you were supposed to complete this. If you wrote it in 2024, you were supposed to complete it with 26 minutes, right? So this is the question that we are going to do, but I just wanted to remind you about the topics that are examinable in paper 2. Firstly, on question 1, they will have the reconciliation. So it's creditors reconciliation, debtors reconciliation, and bank reconciliation statement, and they will be equal to 60 marks, right? So just know that reconciliation in your paper 1 will be the one that have more marks. Then the other thing that will have more marks is the fixed assets. Which is also examinable in paper 1, and cost accounting and the budgeting. So these are the only 4 topics that are examined in your accounting paper 2, right? So I think you will make sure that going to the paper, you understand all of them, especially the the reconciliations, because they are the one that have more marks in your exam, right? But I will do a separately video for the reconciliations, because I want you to understand more of them. But this case, I just want to remind you about the fixed assets, which is the note number 3, and a lot of people often struggle with that, right? So let's come to our question 2 of this question paper, which is the question that we'll be answering today, right? So let's let's get straight to the question. Firstly, this is the question paper. So question 2, fixed assets, Olympic stores, so which is the name of the business that we are doing. It is very important to know the name of the business so that you know the business that we are dealing with. So it is Olympic store. They are saying that the following information was extracted from the financial information of the Olympic stores for the year ended on 30 June 2024. So our financial year end is 30 June 2024. Sometimes you can say they usually say 29 February. So please take note and read this information, because some people often assume that every financial statement has a financial year end at 29 February. So it is important to read and see what is the financial year or accounting period of each business that you are doing. So 2.1.1, they say we must describe the historical cost principle and its relevance to fixed cost, right? By giving example of how this principle is applied. So remember, guys, in accounting at grade 10, also I think 11 and 12, there's something called gap principles, right? So I think there are 8 is materiality, historical cost, prudence, what's the other one? I forgot the other ones. Or it's matching principles. I forgot the other principles. So they will always ask you about the principles. It's very important to know the principles, because they apply in income statement, in all of the accounting information, accounting records, and disclosure. We often rely on the gap principles, because they are the one that guide the accountants on how to record their financial information, right? So in this case, they asked us about the historical cost, but historical cost. And there are 2 questions here: is to explain what is historical cost, and also why or how it is relevant to fixed cost, right? So historical cost, it says that if an asset is bought, it must be recorded at its cost, original cost, right? So this is what I will read this definition because I think it makes more sense. So historical principles means that all the assets are recorded in the books of the business at their original cost. This is very important. So meaning that the amount paid when the asset was bought, right? So that means the historic cost. Let's say, for example, now we're gonna describe how it is relevant to fix the cost, right? Let's say we bought a machinery, and this machinery costs us 100 rand, right? So now this machinery depreciated by 20 20 rand during the year, and the accumulated depreciation would be 100 minus the depreciation, and it will be 80 rand, because it will be 100 minus 20 and 80 rand, which is accumulated depreciation. And the question says and asks you, what is the cost of this asset? So are you going to say it is 80 rand, or are you going to say it is 100 rand, the one that is was the one that you paid when you're buying the asset? So that is what historical cost is here for, is to guide you on which cost or which price to use when recording the assets. So remember, it is the original cost that the business paid when they're buying the asset, right? So that means if they ask you that question, 100 rand will be the cost of the asset according to historical cost. So you must reference, why are you saying that? According to historical cost, every asset that is recorded in the books of the business must be recorded at their original cost. Then now the second question says, explain or describe the historical cost and its relevance to fixed costs by giving example of how this principle is applied. So as I said, this is my examples in numbers, but now let's see how you can theoretically express just example. So if a vehicle was bought for 200, it will always appear in the books of the business 200, even if its market value changes later. So what changes the market value of the assets? Firstly, it is the depreciation right here. The depreciation, remember guys, when you're saying the cost minus accumulated depreciation, will get the carrying value, right? So at the beginning there is no depreciation, so there is zero accumulated depreciation, so the cost will the carrying value will be equal to the cost, right? So now the carrying value is equal to when you come into the carrying value at the end, you will say plus additions minus depreciation, then we'll get the carrying value at the end, right? So that means that the cost of the asset will be less than, not the cost, but the carrying value of the asset will be less than the cost at which we bought the assets for. So now if we bought the assets at 200, let's say the carrying value now will decrease to 1800. So now, so that means that according to historical cost, a cost of the asset will not be 180 after the depreciation, but will be before the depreciation, which is the price at which the asset was bought for, right? So please, I hope you understand that. So there is another gap principles that they asked here, but before we talk about it, I will like to explain it to you, and also I think you'll understand it. So 2.1.2 is saying that the gap. So guys, before we go to 2.1.2, it is important to read the question, because someone can just explain the historical cost and do not give the examples, which is also asked, because in this question they ask you two things. First thing is to define the gap principles, which is historical cost, and the other one is to give an example or how it can be applied by considering its relevance to the fixed assets. Remember, fixed assets, land, building, equipment, or machinery. Yeah, there's a lot of fixed assets. Coming to 2.1.2, what gap principle is applied when depreciation is written off on the fixed assets? So what gap principles do you think is applied? Firstly, I said we have the historical cost, which I just explained. Asset is recorded at its original cost. The second one is the what's this, matching principles, at which they saying that incomes and expenses that belong to this financial year must be recorded in this financial year. The one that belongs to next year must not be recorded to this financial year. So that means they are deducted in the financial statements, like income statement. Then we have also the prudence, and say prudence, they say that assets must not be overstated or undercosted. So prudence often apply more on the bank reconciliation statement or on the reconciliations, because that's where the mistake of overstation or understation usually happen. Then there's also materiality, and in this case we'll apply and read what materiality is. But there is also another one that was talking about the future. Yes, it is going concern. Yeah, so it is concern about the future of the business. So that one is about the future. Once you see something about they are concerned about the business's performance in future, that one is going concern, right? Yeah. So let's come to the definition of materiality and see how why is materiality the only one principle that applies to the depreciation, right? To the depreciation that is written off against the fixed assets, right? So firstly, let's define what is materiality. Materiality means that information is considered important or is considered material if ignoring it. So you see, information is considered important or material if ignoring it or recording it incorrectly could influence the decision of the users of information, of the users of financial statements or users of information. E.g., let's say for example you recorded the depreciation and it is not deducted on the fixed assets. That will affect the statement of financial position or balance sheet, because you know that when we go to the balance sheet, all the assets are recorded at the carrying amount, and the carrying amount is the asset minus accumulated depreciation. You get carrying amount, then you say minus depreciation for the current year, you will get carrying amount of this at the end, right? So that means that, let's say for example, if now you didn't write off the depreciation against the fixed assets of which now you were calculating the carrying amount, that will affect your statement of financial position of fixed or balance sheet, and now that will affect the users of information. Maybe you don't know who are the users of information. So the users of information, these are the relevant stakeholders like investors, customers, business employees, business managers, and also people who would like to collaborate with the business and doing the business with the business, right? So let's say for example I'm an investor, I want to invest with the business. So now you didn't write off your depreciation to your fixed assets, so that means that your assets now will be more than it is supposed to, and now that one is the misleading information, because I will take that information as true, of which it is not, and invest to the business, and now the return on investment won't reflect the actual money that I invested. So now the action doesn't speak as the money or the financial values are put on the statements of financial position or balance sheet, right? So that means that materiality, it is the one that apply to what to the cap principles. It is the cap principles applied when we depreciate. Depreciation is written off or is deducted on the fixed assets. Fixed assets, remember, vehicles, equipment, machinery, land and building. Or not land and building, because land doesn't depreciate. So why now? So why we can say that? I think I also, or I explained it. I explained it here, because if depreciation is not deducted, that means that that will reflect a misleading amounts on the balance sheet. So remember this materiality, I didn't define this gap principles because I knew that I also spoke about it in this memo, right? So this means that the information is considered as important or material if you ignore it or you calculated it incorrectly, could influence the decision of the users of information. So let's say for example, in your profit, when you're doing the income statement, you made a loss by a mistake, because when you say minus the interest expense, you said minus 1 million, of which the interest expense was 1000, but you made a financial error and you said minus 1 million, and you will get not a profit but you will get a loss. Do you think now, is there anyone that will want to do business with you, or is there any investor that will be interested to invest in the business? No one. So that means that that information of the interest expense being written off against the profit before interest expense, it is material, because its influence, it could influence the decision of the users of information, right? So I think that is clear and you understand that one. So coming to 2.1.3, then it's saying that explain two internal control procedures that the owner, I like this question because they always ask it, especially on paper two, because they know fixed assets appear on paper one and paper two. So on paper two, it's like they also want your understanding, not just any calculations, right? So 2.1.3, explain two internal controls procedures that the owner of the business could implement in order to protect the financial assets of the business. Sometimes you can say to protect the cash, especially when doing the reconciliations, because so we dealing with the cash sometimes. So they can say, how can you protect the cash at the bank? So you please also read those ones. How can you protect the cash of the bank? How can you protect the collection of cash from debtors? So that means there must be a segregation of duties. Please don't remember that one when doing the reconciliations. I don't know why I keep referencing on reconciliations when I'm doing the fixed assets, but I will make a separate video for that so that you also understand that. So this question right here says the business, how the business, or explain these two internal controls that the business may implement to protect their fixed assets. Remember, guys, let me explain what internal control procedures are. So these are the procedures that are practically applied within the business. It's either to protect the financial records of the business, to protect the day-to-day operations of the business, or to protect the staff within the business. So now we want to protect the fixed assets of the business. Remember, fixed assets, they are four. So we have land and building. So we have to protect the land. That is why there is always a yard in a business. Now coming to the vehicles, we have the delivery guys who deliver goods far away from the business. So let's say this is the question: how we can protect those vehicles that are going out of the business, and there's no one that knew where are they going, right? And everyone know right now that a lot of the people that are using business vehicles, they don't only use them for the business use. Sometimes they can end up using them for the personal use and go with it for personal reasons. And we have equipment. People at the admin can use the equipment to go to TikTok by using the wife of the business, watch TikTok on the computers and everything. So how can you protect those things? So this is the question, guys. How can you protect those machinery of the business by using the internal control procedures? So these questions, most of the times, they just need your understanding. But before you understand, you must know what the internal control procedures are. And I think now, since you understand them, then we can explain any two procedures that the business can make to protect those fixed assets, right? So the first sentence that I think is important, I pointed out, there must be a physical safeguard of the assets. So that means that they lock the assets up, e.g., there must be security for the machinery, something like a supervisor, someone who is looking after the assets. Let's say, for example, this is the factory business, and now there must be physical, not just a camera, because something can be violated and be seen on the footage, but now what else after, because it is already violated. So that means that there must be a physical safeguard of the assets. So that must be physical human being there for supervision purposes or security for the machinery in the factory. So now what else to the vehicles that the delivery vehicles, they are taken by the people, not just any people, but like the staff, they use it for the personal use. So how can I protect our vehicles as a business? So we must install tracker devices to the vehicles to be able to see where are the vehicles or assets going, or where are they moving. So for example, here the delivery vehicles, so that you see, okay, the the location was at let's say Johannesburg, but now we see how this person went to Cape Town. So that is the concern, where the concern is coming from. We implement those internal control procedures so that we protect the assets of the business, because at the end of the day, that person or that staff or the delivery guy won't pay the depreciation expenses. The depreciation of the assets being for being the assets used will be paid by the business, and that person will also be paid for using the asset for personal expenses. So that is why the business have to protect their assets, right? So I think that makes more sense. Let's move forward to point two. I know note number three is actually sometimes it doesn't make sense, because let's say, for example, it doesn't make sense because it's just a complex things, or information included together, and I will try to make it make sense more, because I understand I actually like this topic, because the reason why I like this topic while I was still doing the grade 10, 11, 12, it is because you can actually prove what you did. So you can actually prove if you are right or wrong by just trying to calculate the cost at beginning or cost at end by using the amounts at beginning or at end. So I will try by all means to make it make sense, guys. So remember, in this note number 3, this is the note that is recorded on the balance sheet, but now in paper 2 we won't be doing balance sheet, right? So the only focus on you is this note only. Remember, this is the note on the balance sheet. There are a lot of notes on the balance sheet, so this is note number 3. So information at the carrying value at the end is the one that usually taken to the balance sheet. But in this case, or for paper 2 purposes, you must only know how to calculate the depreciations, how to deal with the additions or new assets both during the year, and how to calculate the carrying amounts, accumulated depreciations, and accumulated depreciations at the end, right? So let me define the concept for you so that you understand, right? So firstly, we have the cost. This is the cost that we bought the asset for, and according to historical market principles, they're saying that every asset must be recorded at the business with the cost, or with their original cost. Then now the accumulated depreciation, this is the depreciation for the years. Let's say, for example, we bought an asset in 2015, and now that asset is still available in 2025. So that depreciation, accumulated depreciation, is the depreciation from 2015 until 2025. It's accumulation, as you can see. So now we have the carrying amount. A carrying amount is the cost minus accumulated depreciation. So this is the one that is the actual. This is the actual value or cost of the vehicle at that time or at that point in time. So let's say, for example, if the cost of that asset we bought in 2015 is 200,000, and now when you say carrying a cost minus carrying accumulated depreciation, you'll get a carrying amount of 20 rand. So that means that asset now, its value, it is valued at 20,000. So it's no longer 500,000 that we bought it in 2015, but according to historical cost, they are saying that we must record that asset uh, at their original cost price. Then the movements, that's where we have the additions. In additions, we write the assets we bought during the year. Let's say we bought the assets during December. So that means the assets from December now will start now to depreciate. And also there's another asset that was available at the business at the beginning of the year. So now there are two assets that will depreciate. Is the new asset that bought during December, and the old asset that was available as from December, right? From December, not from December, but from the beginning of the year. Right, so carrying amount at the end is the same as I explained at the beginning, right? But I will tell you the formulas of this as we go through the video. So 2.2, they're saying that we must calculate the missing amounts in the fixed asset note of the Olympic store on 30 June 2024. That's why the main purpose of the video is. So please guys, watch till the end so that you get more information about this, and also don't forget to like, subscribe. 2.2, 2.1. Before we go there, let's talk about this formula, right? I think, yeah. So I want to remind you about how to calculate the cost at the end. So the cost of the end, according to this question, is this one, guys. This is the cost at the beginning. At the beginning, our year ends in 30 June, so that means at the beginning is July, and at the end is 30 June. So if they asked you about the cost of the end, how can you calculate it? I know this, the costs are given, but how can you calculate it? So think about it. This formula will do, or make you know how to do it if you don't know, right? So firstly, the cost of the beginning plus the cost of the new or the addition of asset is equal to the cost of the end at end, right? So that means now if we have the cost at beginning and the addition, we can get the cost at the end. So now what if we have the cost at end, we have the cost of the new asset, but we don't have the cost at the beginning? So that means we can say cost at the end, then we transfer the cost of the addition so that you can get the cost at the beginning, right? So this is the formula. I just want to remind you, just know it mathematically also. Cost at the beginning plus cost of the new asset is equal to the cost at the end. So this you must try to memorize so that you don't forget it, because there is no way you can know how to calculate this if you don't know that formula. So every formula you must know it for you to apply it. So 2.2.1, depreciation, remember, doesn't depreciate. No, I mean land doesn't depreciate, right? Land and building 2.2.1, they're saying that we must calculate the cost at the beginning. As you can see, guys, 2.2.1 is the cost at the beginning. So let me try to erase everything because I think it is too much now. Yeah, so it's 2.2.1. It is the cost at the beginning of land. And as you can see, guys, in additions, there is an addition here. There was something, but before you calculate anything, go to the additional information to see if there was any changes during the year, right? So Roman figure number one, talking about the land and building. During the year, an invoice was received from builders suppliers. So that's supplier. That is the supplier of us, right? So they're saying that for the following, a new storeroom was built. So we built a new building here of costing 450,000, which is the addition, right? They're saying that repairs on existing building which costed 20,000. Remember, guys, repairs is an expense. So an expense is recorded on the income statement, not on the balance sheet. Remember, this note is going to the balance sheet. An expense is deducted on the operating expenses in the balance sheet. So this 20,000 of repairs on existing businesses, it is the expense. So the cost of the addition or the new building built is 450,000. So you can see we know the additions, we know the cost of the end because it is given there is 1,300,000, but actually we don't know, unfortunately, the cost of the beginning. Then now how can we calculate the cost of the beginning, guys? So you know cost at the beginning plus additions, they will probably give you the cost of the end, right? So there was something that we usually say that when you're going up to cost at the beginning, you change the sign. If you were adding that thing when you're going down, now you must subtract it. So the cost of the end include the additions, right? So you must deduct the additions, then you will get the cost at the beginning. So, but now let's see how we can do that. We have the cost at the end, we have the cost at the of the addition, but now we don't have the what's this, the cost at the beginning. So this is the question mark, but we actually have the cost of the new assets or the acquisitions and the cost of the end. So you see, guys, there's only one thing you know here, and a lot of you maybe some of you are doing math and some of you doing math lit, right? But this one is the basic way in mathematics. If you were about to put solve for x here, how you can do, you can transpose this 450,000 to that side, right? And you'll see you have the cost at beginning, so it's the cost at end minus the additions of 4 million. Oh no, it's not 4 million, 450,000. Then we'll get 850,000, which is the cost at beginning, right? So I don't know, we won't be able to write it. Let me try so that we know. Well, so the cost at the beginning is 850,000. That's 850. Let's just write 850. And here the additions, as you said, is 450. They didn't write them. I don't know. Maybe they're trying to confuse you. It's 850,000. So 2.2.2, guys, it's here. You can see 2.2.2 is here. They are asking you to calculate the additions. I don't know why, because the additions of 450,000 they is given to you. So this one is just easy because for the 450 already said it is the additions for land and building, because there was a new storeroom that was built, so there was addition of the building. So 4.2.2 is 450,000. That one was just a free mark for basically, right? So before we proceed to another question, I want to remind you about this other formula right here. I spoke about it before. Cost minus accumulated depreciation will give you the carrying value of an asset, right? So it's a cost at beginning minus accumulated depreciation at beginning will give you the carrying value of the asset at beginning. But now if you say cost at end minus accumulated depreciation at end, you will have the carrying value at the end of an asset. So 2.2.3 is saying that here you can see 2.2.3 is straight to the accumulated depreciation. So guys, you can see here they didn't give you the accumulated depreciation, but they gave you the cost, which is 550, and they gave you the carrying value, which is 250,000. But remember, when you say cost minus the accumulated depreciation in 2.2.3, you got 240,000. So you can say now 550,000 minus the carrying value, will get the difference that was deducted, which is the accumulated depreciation. But now let's see how we can do that, because sometimes it's usually confusing. How I was doing it, I would like to know the ordinary formula of it, so that I can just substitute in the formula and see what I don't have, then get what I don't have, right? So you have the cost of 450,000 in the vehicle they gave you. But that's another thing. When remember to know which side are you on. You are on the vehicle, so don't use information on the equipment to answer the questions on the vehicle. Don't use information on the land and building to answer the questions on the vehicle. So the cost of an asset in vehicle is 250,000 and the carrying value is 240. So the substitute cost is 550. Accumulated depreciation is the question mark, is what we don't know. The carrying value is 240. So according to you, we say that calculate accumulated depreciation. How you can do? It has a negative balance, right? So you can just transfer it to that side. So you can say take this one to this side and take this one to this side. It will be 550,000 minus 240,000, which is equal to accumulated depreciation. Then accumulated depreciation will be the difference of that. Then it's 310. But now you also have now another formula that you can create for yourself, that when you say cost minus carrying value, it will definitely give you accumulated depreciation. So I was that kind of a person. When I saw something, okay, now it goes like this, I create another formula, because you already know how you can get carrying value. But now, okay, there's another formula that is coming up. When you want the accumulated depreciation, you say cost minus carrying value, you will get your accumulated depreciation. So this is the cost. You can write it right now if you have a book and a pen. So let's proceed to the other questions. It's 2.2.3, right? But before we go there, is there any reminder? Yes. We have the reminder of that cost, definition of that cost formula. Cost at beginning plus cost of the new asset or addition is equal to the cost of the end, right? So let's say 2.2.3. Sorry, where are we? We already calculated 2.2.3. What's oh, it's 2.2.4. Sorry, which is the additions. Okay, interesting. So we have the cost at beginning, right? 550,000 of the vehicles. We have the cost at the end is what? Is 700,000. So guys, this is what I want you to notice when doing this thing. So you can see the cost at beginning is 550,000. Remember, cost guys doesn't change and it's not affected by the depreciation. So an asset is recorded at its historical carrying historical cost. So now if you see that the cost now changed to 700,000, increased, that means there was an addition of cost during the year. So that means there was an addition of vehicle bought during the year. You can just know that without even calculating. So we already know by looking at here it's 700,000, but when you see at the beginning it was 550. So that gave us an indication that okay, we added another asset here. If it decreased, that means you sold another asset, but I don't think that one is covered in trade 10. I think they cover in trade 11, that one for a sold asset. But now you can see there's an increase 700,000 from 550,000. So now if I can ask you to calculate that addition or that vehicle bought during the year, how you can calculate that? You know, you already have the cost at the end, you have the cost at the beginning. Just take the difference, it will be the addition, right? So because you said, as I said, when you are going up, you minus what you were adding and you subtract what you added. So now we already added additions. So we're gonna say 700 plus the additions. No, not plus, but minus. Then we're gonna get the cost. But now we already have that cost. So we say the cost plus additions. Then we got 700,000. So now we're gonna just say 700,000 minus 550, and we'll got the addition cost of a vehicle, which is asked in 2.2.4, right? But now let's come and put it in our formula and substitute it. Remember, as I said, I always like to substitute so that something will just give you an indication of another formula. So the cost at the end, it is given to you 700,000. Cost at beginning is 550. Cost of the new edition, it is not given. That is a question mark, right? So now, as I said, we'll just transfer the cost at the beginning of 550 or subtract it to 700,000. So you say 700,000 minus 550, you get the cost of the new asset. So now, this also create another formula for you guys to know. So addition of an asset is equal to cost of the asset at end minus cost of the asset at the beginning. So you can just in your notes write that formula there. But guys, as you can see, I don't trim them. I understand by just looking at the note number 3. You can see there's a difference here. 700, 550. That means there was an addition to get the 700. A number doesn't change without addition or subtraction, right? So that means there was an asset bought during the year. So now let's come to 2.5. That also, guys, may give you an indication. When you calculate the depreciation, now you have a responsibility to calculate the depreciation for the asset that was available at the beginning, where that asset that the business opened with, which has a cost of 550,000, and the depreciation of the asset that is bought during the year from the time it was available for use, which means from the time it arrived to the business or it is used to the business, that's where it will start to depreciate, right? So the addition will also be another depreciation. So the total depreciation for the vehicle will be at depreciation for the old vehicle and the depreciation for the new vehicle, which is the addition. So 2.2.5 asked us to calculate the depreciation for the vehicle, right? But before we go there, I want to remind you about the methods of calculating depreciation, right? Firstly, we have the cost method. Cost method depreciation will be equal to the cost of the asset times the percentage they use to value or depreciate the assets times by the month divided by 12. So what is here in the month? So now that's where, let's say if we bought that asset in June, 1st of June, and you know our year ends in 30th of June. So that means that asset stayed for only 1 month, divided how many months in a year? 12 months. So that those months are the months at which the asset was available for use in the business, right? So please know that. Coming to the diminishing balance method, and also not just new depreciation, an old vehicle that was available from the beginning of the year. That means that assets stayed for 12 months. How many months in a year? 12 months. So it's 12 over 12. Right. So coming to the diminishing balance method. Here the depreciation is calculated on the carrying value. Right. So how we can calculate the carrying value? It is the cost minus accumulated depreciation, as I said before. Then the depreciation, you will use the carrying value to calculate the depreciation. So depreciation will be equal to the carrying value times the percentage they use times by m over 12. As I said, m will be the months that the asset stayed during the year, and 12 is just the months in a year, and the year has only 12 months. So please, guys, know these formulas. They are going to tell you in the question that the vehicle or equipment using which method between the two. There's no another formula. From now until dry 12, these are the only formulas you will use fixed assets, right? And until university, it is the same. I'm still using them here. So let's see which depreciation method does vehicle use. Come to your additional information. Roman figure number 2, they are saying that a new vehicle was bought for cash in 1st November. We already know that there is a new vehicle that was bought here. As you can see, we calculated in 2.2.4 that addition. So we already know that there's a new vehicle. So this will help us to know the months that the new vehicle stayed within the business and it was used. So Roman figure number 2 says that depreciation is depreciated 20% using cost method, and I like so much cost method because you don't have to struggle to calculate the carrying values and everything. You just have to take the cost and calculate the depreciation. So according to cost method, to vehicles, they are depreciate their assets at 20% on or per annum on cost method. But remember, guys, we have the vehicle that the business opened with, which was costing 550,000, and there's addition, and we calculated the addition in 2.2.4. The addition was 150,000, which is the new asset that was bought. It was 150,000. I want to write it here. The new asset was 150,000. So now we want to calculate the depreciation for the old vehicle of 550,000 and the new vehicles. First, let's start with the old vehicle, which is 550,000. As I said, guys, that vehicle stayed for the whole year. They didn't sell it. So that means it is 550,000 times by 20%, the one that they use. And you can say, if you want, you can also say times by 12 over 12. But guys, remember 12 over 12 will cancel each other. So that means there is nothing. So you can just do it like this, because at the end of the day, there's no much time on doing the accounting exams. So the depreciation you will get is 110,000. Remember, guys, this is just the depreciation for the old vehicle of 550,000 that the business opened with. So now we have another vehicle that the business bought during the year, and they bought it in November, 1st November 2023, and the year that we accounting period ends in 30 of June, right? So that means that we must calculate from November the months that the new asset stayed in the business, right? No, we can't say 12 over 12 because this asset wasn't available at the beginning of the year at 1 July 2023. So it was available from the 1st. Remember, guys, this thing of 1st. Sometimes they will say 1st of November, 1st of November, and sometimes they will say at the 30th of November. Remember, guys, when you bought something at the 1st of November, that means that from 1st of November until 30, you are using it. So it was also available for the month of November. But now, if you bought it at the month end, at 30 of November or 31, that means that you didn't use it the whole November. You started to use it in the 1st of December. So that means, and now that asset won't depreciate for November, but will start to depreciate in December. Take note of that. So now they say bought for cash on 1st of November 2023. So let's see to the timeline. How many months did the new asset stay with the business? Remember, our year end in 30 June 2024, and it start on 1st of November 2025. So this is the timeline I was using throughout high school accounting, right? So this is July, August, September, October, November, December, January, February, March, April, May, June, our year end on 2024. So a new asset was bought in 1st of November. So 1st of November until June. So let's calculate the months that the new asset stayed in the business. So it's November, December, January, February, March, April, May, June. And you can see that, let me count, November, December, January, February, March, April, May, June. Those are 8 months. So this asset stayed in the business for 8 months. So the depreciation that we are calculating is 8 months. And which cost are we using? We are using the cost of the new assets, and the cost of the new asset we calculated in 2.2.4. It was 150 or 130. I think it was 150. Yeah, it was 150. So let's see how we calculate that. Depreciation is 150 because we're using cost method, times the percentage, then times the month divided by 12. Then how many months did the asset stayed or used in the business for this accounting period? 8 months. How many months in a year? 12 months divided by 12. Then we'll get the depreciation, which is 20,000. But remember guys, they didn't ask us to calculate the depreciation for the new asset, but depreciation for the old vehicles. So it will include both new asset and the old vehicle, which is 20,000 plus 110,000. Then you'll get your 130,000, which is the depreciation for the whole or for both new and the old vehicle, right? So just take a moment and look here and see if is there anything that you think you don't understand, and you can just, because you can just write a comment, ask, okay, how did I get that? I will also explain in the comment section any question that you have, right? So let's proceed to the other questions. But guys, just a reminder, don't forget to like and also subscribe, because that will also help the channel to grow and reach so many students as possible, so that everyone can learn. Share this video to your classmates. So we move now to 2.2.5. No, which one? We were doing 2.2.5. We moved to 2.2.6. Now we are on the equipment. We are done with the land and the vehicle, and I think that was a good explanation and understanding between the two that I made, right? So now we come to 2.2.6, and they want the carrying value at the beginning. Let me remind you about the formula I told you before. Cost minus accumulated depreciation is equal to the carrying value. This is the formula that must stay in your mind. Cost minus accumulated depreciation is either at beginning or at end, but they will give you the carrying value, right? So 2.2.6 carrying value, they ask us to calculate the carrying value, right? So the cost, let me see, I think is too much. Let me use eraser, because now we can't see now. Yeah, I think everything is clean. Yeah, okay, the cost is 450,000. Accumulated depreciation is 180,000. This one is just clear. You use your formula to get this. So you will say cost, which is 450,000, minus accumulated depreciation, which is 180,000. Then you will get your carrying value. Then let's see how much is the carrying value. I think quick student already got it. 450,000 minus 180 is 270,000. So guys, I hope while we are doing the videos you are taking notes, and also you are taking notes of the formulas, because I just don't just want you to understand at the moment, but also like write notes. As you can see guys, I'm also reminding myself about the formulas. I can't just explain everything. I want to remind you, because that's how I was doing it. I was taking notes, so that before I attempt any question, I check, okay, the reminders that I wrote for things that I have to know before I attempt any question. So please take notes as we are doing the video, so that now after the video, you don't have to come back to the video and look, what did I say? No, take notes as we are doing. And what I like when watching a video, you can stop it and take note. Then you can write, you can continue, or you can just say 30 minutes back, you can write what we want to write, right? So we already got the carrying value of the equipment, which is 270, cost minus accumulated depreciation. So let's move to 2.2.7. 2.2.7, which is the depreciation of the equipment. Nice. Remember, we have the cost method and diminishing balance method. And the cost method, depreciation is calculated using cost price. But now on diminishing balance method, which is used in equipment, Roman figure number 5, equipment is depreciated at 10% per annum using diminishing balance method, right? So now we're gonna use carrying value to calculate depreciation, not cost. Let me remind you, because I know you forget a lot. I was also forgetting while I was still in grade 10. Diminishing balance method, depreciation is calculated using the carrying value. So carrying value is we're gonna use carrying value and times the percentage they gave you, of which now in this case is 10%, times the months of the asset that is was used or stay in the business, and divided by 12 as usually. Then let's see if there was any addition or additional asset. No additional. How what is it? Additional equipment bought during the year, so that we know that we calculate asset for the new vehicle and old vehicle, right? So where is it? They're saying that on 31st of December 2023, equipment with a cost of 100 or 18,600 was purchased on credit, but no entry was made. So the reason why they say no entry was made, it is because here there is no any additional asset they wrote. That's why they have those 3 stars. So we bought it, doesn't matter how we bought it, the type of payment which is on credit. You'll see here the vehicle was bought on cash. It doesn't matter. We're not doing the cash accounting equation or anything here. It doesn't matter at this point. We don't want, or we're not interested to know the accounts that are affected, but we are interested to know what happened. So on 31st of December, now we know. Remember, I told you about this thing. I told you that sometimes they will say on 1st of November, and sometimes they will say at 30th of November. And now they did was exactly what I was warning you about. So they're saying on 31st of December 2023. So we have an addition of equipment costing 18,600. Firstly, remember at the beginning of the year there was equipment costing 450,000. So that means that we also have to depreciate the asset that was available from the beginning until the end, and the asset that was available from 31st of December until the end, right? So let's start with the old vehicle. So not old vehicle, old equipment, right? So the cost of the old equipment, as you saw, guys. But now remember, we're not gonna use the cost 450 to calculate the depreciation, but we're gonna use the carrying value, because they are using diminishing balance method, and the depreciation is calculated using the carrying value. So carrying value is we calculated in 2.2.6, and it was 270,000. So we're gonna say 270,000 times 10%, will get your depreciation, which is 27,000 for the old vehicle. And I want you to take note, if they gave you the carrying value at the end, that's not the carrying value we are going to use. You are using the carrying value at the beginning, because the asset that you are calculating a depreciation for is the asset that was available at the beginning of the year. Then now moving forward, we have another vehicle that we bought on 31 of December. So now, are we also going to use carrying value to calculate that depreciation? This is the question maybe some of you are asking themselves. How are we going to trade it? So note, guys, an asset doesn't depreciate without it being used, right? A depreciation is calculated at the end of the year by considering the months that the asset depreciated in the business, right? So that means this new vehicle or new equipment, at that point in time, 31st of December, that was bought in, it didn't depreciate at that point in time, but it depreciated from 1st January until 30 June. And now we don't calculate depreciation during the year. We calculate depreciation at the end of the year. So that means at that point in time, it doesn't have carrying value at beginning. As you can see, this 270,000, it is the carrying value at beginning. So if you can say now that cost minus its carrying value at beginning, it doesn't have a carrying value at beginning. So that means the carrying value will be 0. So that means now if we're about to say carrying value, will say this 18,000 here, which is the addition cost of the new vehicle, 18,600 minus 0 will give you carrying value, which is 18,600. It doesn't change. So for the new vehicle, you can just use the cost as the carrying value, because it doesn't have the carrying value at beginning, right? I think that one makes sense. So let's see how many months did the asset used for the business during the year. Sorry. Sorry for showing the answers. So the asset was bought because remember it's July, August, September, October, November, December, January, February, March, April, May, June. Then the asset was bought in 31st of December. 31st of December, that means the whole December, from 1 December to 30 December, it wasn't used. From 1 to 31 December, it wasn't used. That means December is not accounted for the depreciation. The depreciation will start on the 1st of January until 30 of June. Here they're saying that the asset was bought on the 1st of November. So that means 2nd of November we started to use the asset until 30th of June. So that means that is why we included November here. But now December here won't be included, guys. I think that one makes sense. So the cost of 18,000 is the one that we're gonna use, times 10% times 6 over 12. Remember, we're gonna now say January, February, March, April, May, June, which are the months that the business was available for use in the business. So 1, 2, 3, 4, 5, 6, and how many months in a year? 12 months. Then if you say 18,600 times 0.10 or 10% times 6 over 12, we'll get 930,000. So this is the depreciation for the new equipment. And the question didn't ask us to calculate the depreciation for the new equipment. They wanted the depreciation for the equipment. So that means it's a new plus the old. So let's calculate the total depreciation for the equipment, which will be 930, which is new, plus 27,000. Then we'll get 27,930, right? So guys, remember I did a couple of videos on paper 2 accounting. Remember, as I said to you, on accounting paper 2, these are the topics that will be asked. We are done with our question 1 now. I think this one was a very helpful session that we have. Cost accounting, budgeting. I will link the videos here towards on those topics, right? So please don't panic. It's still early, you can still recover. If you don't understand anything, just go to the comment section and write what you don't understand, or if you understand anything, just go to the comment section, tell me the date and the time what that you will be writing accounting paper 2. And even you can tell me if you didn't write paper 1, the day that you will be writing accounting paper 1, because it is not easy to access the dates that students that are doing drill 10 and 11, their timetable. That don't forget to like and subscribe. Share this video to your friends, guys, so that they can also be helpful as you are, right? I hope so, though. Thank you for watching. I appreciate your effort and patience.